This week on Phil's Tax Hacks and Other Retirement Facts, the Magnificent Seven and the S&P 500. Let's get started. Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Welcome into the podcast. This is Phil's Tax Hacks and Other Retirement Facts, and we're going to talk about the S&P, how it's doing, and the Magnificent Seven, which maybe is the Magnificent Six now, Phil. This week, let's get into it. Just maybe being overly weighted in any one thing. And it seems like a good time to review this because while it is, 500 companies, it's really kind of dominated really by seven or six, right, as some of the new data is showing. So let's talk about that this week.
Yeah. Well, and that's the thing. I mean, it's changed over the years. The reality is the S&P we have today isn't the S&P of 10, 15 years ago. So I mean, it's the principles are the same, right? The composite, how it's developed is the same, but the companies now that are in there have changed the makeup of the S&P, which a lot of times people think of the S&P, to your point. Yeah, it's the index of choice most people like to compare against for stock or equities, right? Oh, it's the S&P. That's the broad market because it's the 500 largest companies. And it is, but the reality is you have to understand the makeup of those 500 companies because how it's made up, I don't think most people realize.
Yeah. And so, if you're thinking about the Magnificent Seven, and if you've heard that term, great, you know what I'm talking about. If not, we'll elaborate a little bit more. But, it used to be the FANG stocks, right, Phil, right? So, it was the FANG stocks, Facebook, Apple, Alphabet, Netflix, and Google, I think. And now they're calling it the Magnificent Seven, but really it's more like six now. So kind of elaborate on what's happening.
Right. So, I mean, right now, the S&P top 500 companies, it's got a market cap, if you added up the value of all those, of like $45 trillion. So when people think of it, it's like, oh, well, that's a broad market diversification. And that's how a lot of people think of the stock market being the S&P 500. But you have to dig in to understand, well, what's that made up of? How are those 500 companies laid out in the S&P, so to speak? And it's not like most people think of, every company has the equal weighting, right? There's actually an index that's the S&P 500 equal weight, where all companies do have an equal weight in there to give you an idea of truly that broad diversification. But the S&P 500 as an index is designed to be what's called cap weighted. Simply put, the larger the company, the bigger the percentage of the S&P it comprises. So the reality is this, as it stands today, it used to be 7, now it's down to 6 that make up over a third of that index. And they're all tech. And it's even worse than that because if you look at the top 20% of the S&P, more than 20%, it is made up with just 3 companies, NVIDIA, Apple, and Microsoft. Those 3 companies represent 20% of what the S&P 500 cap is. There's $10 trillion in those 3 companies compared to $45 trillion of the S&P. So more than 20% in those 3 companies, which are all tech.
So obviously, Phil, that's a problem, right? Because if something wreaks havoc on tech, stocks for a day or a week or a month, that's a big deal.
And we've already started to see that, it's very volatile. And I mean, NVIDIA is a perfect example. AI, right, has kind of been the big push this year in tech. And that's why NVIDIA has skyrocketed to where it's at now in the S&P as, that I think it's now the number 1 spot.
Yeah, I think NVIDIA and Apple are just trading punches for the top spot.
Right. They're kind of back and forth. So, but the next 3 are Amazon, Alphabet or Google and Meta. So again, 3 other tech companies. And they make up 5.4 trillion. So more than 15 trillion out of the 15. So more than 30% in those 6 companies. So it's not that broad market index that you might want to think. It is heavily tech weighted. And that's just those 6 companies. There's out of the other, 494 of the 500, there's other tech companies in there too. So, I mean, it's becoming very heavily tech weighted as an index.
All right, Phil. So let's bring this down for our listeners a little bit, just to kind of simplify it for how it might affect them, right? If you're thinking about the point of diversification, and looking at what it is that you have and why that you have it, if tech suffers a heavy blow, then and you're heavily weighted, you're not really diversified. Even if you got a bunch of tech companies, you're still going to get kind of hammered. So it's really important. I mean, it kind of drives that concept back home, does it not?
Right. Absolutely. And even if you're going to use the S&P, do you want to use that straight index or the equal weighted? And they kind of change places over time. Right now, the cap weighted index is far outperforming the equal weighted. So looking at it right now today, the total return of the S&P, the cap weighted index, is like 17.7%. Equal weight, so take all 500 companies and give them all the same weight, 4.9. So there's the difference of the cap weighting of those 6 companies, right? So here becomes the risk, and this is the concern, the real risk I see in looking at the S&P, because I think people look back historically at the S&P and understand the volatility, and they might not even be comfortable with the volatility that it's had in the past. Unfortunately, with where we're at in the S&P today, I think the volatility you're going to see is going to be even more, because it's starting to shift more heavily towards tech, which if you want a picture of tech, then look at the NASDAQ. I mean, that is the quote unquote tech index. I mean, it's up 23% year to date, right? So, I mean, that kind of tells you the story. They're running neck and neck. But the S&P, look back historically at what it has done in volatility. It's much more historically volatile than what the S&P is. But unfortunately, I think where the S&P is today, the historical volatility of the S&P is going to be low to what you potentially could see in the future because of this shift to high tech weighting. So it's just understand what you're investing in, right? It's past performance, no guarantee of future results. You hear that all the time. Don't just look at the numbers and say, oh, well, this is, an S&P fund and it's done this in the past, so that's kind of what I expect. But understand now the shift and the makeup of it.
Right, Phil, but that's the point. That's what most people do, right? I mean, if you can't handle being in the market for 10 minutes, don't be in it, or 10 years, don't be in it for 10 minutes. Something like that is what Warren Buffett said, right? And so you got to have a complete strategy. This is the point of having a strategy. It's not just trying to eke out a little bit more from the hot things that's going on, because the hot things are not going to last forever. And yes, well, you've been on this tear for a while, especially the tech tear. But again, you've got to have, especially as you're getting closer to retirement, you've got to have multiple staples going on to help you stay truly diversified.
Well, and to your point of, the investing for the long run, if you're chasing returns, which at this point, if you're looking at the S&P and saying, I want that, you're too late, because it's done that. All right. So where you're going from here, looking back historically, even, chances are, it could grow from here. Who knows? Could go down from here. Over time, it's going to do both. Just understand I guess my point with it is just understand what you're investing in. It is not the broad diversified index that most people think it is. It is very heavily tech weighted. So it's very heavily tech weighted today. And if that's something you're comfortable with, and if you look at the NASDAQ and that risk, that volatility is okay, but you want something a little bit less, well, that's kind of what the S&P has become. It's not as much of a diversifier as it might have been in the past as the large cap. It is still the large cap, but it's, you just understand what it is and the risk that you're comfortable with. I guess, and this is kind of bringing it full circle, because at the end of the day, everyone wants to compare to something. Well, how am I doing compared to, this index or that? Everyone thinks of the S&P. It's like, well, does it really matter? What are you trying to accomplish in your plan? To me, there's several things that have to take place. Number one, have a plan and a strategy in place to understand a couple of things. Number one, what risk do I need to make my plan work? If I don't need a lot of risk to do it, then you have to make that decision. Well, do I want more risk, and why? Why am I doing it? And if you do, then understand the other side of it is, what's your comfort level from risk? Because everyone likes the 17, 18% up. but are you ready for a 50% down? So just understand the pros and the cons. And when you're investing, to me, don't chase the markets, because you're always going to be chasing a return, and there's always something better. And but by the time you see it, it's too late. Have a broad strategy, understand risk, how you're positioning it, what you're comfortable with, and then build a portfolio around that and let the indices do what they're going to do. Because if you're chasing the returns, you're going to get in trouble over the long haul. And it's always going to be chasing, so to speak, chasing your tail, right? You're always going to be seeking the next best thing and then making the wrong decision, because the reality is most people don't just ride it out, right? They jump in now. It's like, oh, this has been great. I'm going to get in the S&P. And from here, it drops down 10%. And they're like, oh, I can't do that. Look at this. It's down. I'm going to go over here. And then it goes back up. That's just human nature, right? So have a strategy and a plan in place.
Well, I mean, it's the concept of risk. I mean, what risks are you taking in your life now at the age you are? I mean, I'm over 50. Phil, you and I both like our cars. We've got a couple of fast cars. Yours is newer. Mine is older. And I could get it and push it up to 100, but why? Like, I don't want to do that anymore. Yeah, I maybe wanted to do that when I was younger, but I don't feel the need to do that anymore. I don't want to take that risk. That it doesn't break in time, or I don't react as fast or whatever. And so you're playing the same game when you're taking too much risk in the market when you may not need to. It's still the best creation tool for wealth, absolutely. But are you truly taking more risk than you need because you're trying to eke something out? Or does it actually serve a point and drive a narrative for your retirement strategy?
Yeah, because you no longer have that time horizon to ride through it. And you're just thinking, it's like, oh, I'm this many years from retirement. Oh, I can't lose anymore. So as it's falling, you jump out at the wrong time, versus in the past, you understood that long-term time horizon. You went through the ups and downs. And if you're comfortable doing that, you can probably get close to that average. And that's the other thing I always say is you have to understand these indices in general and their averages. I mean, the S&P, depending on time frame, you're in the 8 to 10% average return, right? So I always tell clients, hey, if it's above that average, understand you're borrowing from the future. Because if you're getting 18% today, but it has historically only averaged even 10, okay, well, where did that extra 8% come from? Well, it's going to be given back at some point to come down to the average. It's a concept of what they call reversion to the mean. These indices have this volatility up and down, but at some point they come back to that average or mean line. And whenever you're above it, understand you're going to give some of that back at some point. And that's just how markets work. And if you're comfortable with that, okay.
Well, and Phil, that's the point of talking when working with an advisor, is so that they can give you some of this pushback to go, okay, hey, maybe it's time to pull a little off the table. Maybe it's time to take some of these winnings and pocket them. Maybe it's time to look at your tax scenario, pay some of the taxes now, or whatever the strategy is going to call for, and maybe reduce the risk because you're in a good position. I mean, maybe, right? I mean, again, back to the car thing, you've got a newer car than mine, and it's certainly going to brake better than mine, but you're still probably not taking more risk than you'd like to or need to.
Right. Your reaction isn't quick enough. And human reaction, especially when it comes to the market, is always going to be wrong, because it's all emotional driven. It's not comfortable to lose money. When you're down 10%, it's like, oh, that's what markets do. But all of a sudden you're down 20%. It's like, oh, wait a minute, this might not be, it might be more than this. And so when do you get out? And now it's down 30 and now you're out. Well, it goes down maybe another 10, but then it's back up again. Well, when do you get back in? Because we're making those wrong emotional decisions. So understand risk and where you position it, but kind of bringing it back to where we started. What are you comparing against and why? Don't chase the S&P because your buddy that you golf with, is saying, oh yeah, my portfolio is up 20% this year and you're only up 5 or 7. Well, what difference does it matter? Is 5 or 7, does that fit your plan? And what's the drawdown on your 5 or 7 compared to their 20? I can almost guarantee you that they're going to give back a big piece of that 20% at some point in the near future. It's just what markets do. So it's like a gambler, right? They always tell you about the wins. Oh man, I made, $1,000 at the casino last night. Well, that's great. Well, how much did you spend to get that? Last night or the night before? I mean, it's, there's two sides of that coin all the time. So
as always, if you got some questions, need some help about anything we talk about, definitely reach out to Phil.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of The Tax Smart Retiree right now.
That's going to do it for us this week here on Phil's Tax Hacks and Other Retirement Facts. Don't forget to subscribe to us on Apple or Spotify or YouTube. Hit the subscribe button, ring the notification bell, catch new episodes when they come out, check out some shorts, whatever the case might be and that way you catch new content when we drop it. And we'll see you next time here on Phil's Tax Hacks and Other Retirement Facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.